Man, you have answers.
Good morning.
I know.
I'm Andrew Whitaker. I'm Vice Chairman of Jefferies and Leucadia. Thank you all for coming here this morning to hear us discuss alternative investments. The Milken team has put together a great group of panelists here, and I think we're going to have some very interesting perspectives. We have some highly successful managers here. We're going to hear why they think alternatives are good investments and where they see opportunities for investors today. Alternatives are a popular asset class, and it's become very significant. It's about a $10 trillion investment class at this point. Investors continue to look to alternatives for outsized returns, despite the relative illiquidity and high fees associated with them. We're going to start our discussion by briefly framing the investment landscape, and then we'll give the panelists some general questions and then some more specific questions related to what they do. Before we look at performance, let's look at some of the other criteria that investors look at when they are evaluating investment alternatives. As you can see in the chart we've put here, we've contrasted liquidity and costs and put on this chart where various alternatives come out on that front. As you can see in the lower left, we have indices and bonds and just beta-type investments that are very low cost and very liquid. On the upper right, we have private equity, which is the most illiquid and the highest cost. Next to that, to the left, we have hedge funds, which are slightly more liquid, but also continue to be pretty high cost. We've also put on here some other alternatives and where we think that they would come out. Now let's look at what investors really care about, which is returns. We've laid out on this chart various alternatives and what their returns have been for the past year. Although it's impossible to get fully comparable data on all these types of investments. Equities have been so strong recently that they've outperformed virtually every alternative investment class over the past year or so. Some private equity and hedge fund subclasses have performed well recently, but on average, the S&P 500 has outperformed all of these on an absolute basis. Despite these mixed short-term results, however, hedge funds have reached a peak allocation in the first quarter of $2.7 trillion, which is double the allocation that hedge funds had in 2008. So let's look at some fee-adjusted returns for hedge funds. On the left-hand side, you can see that this large hedge fund index only returned 7% over the past year or so versus the S&P, which returned about 20%. However, over a 7-year period, you can see that hedge funds have outperformed the S&P by about 900 basis points. For private equity, if you take a look, let's look at private equity next. For private equity, if you look at the left-hand side here, on a 10-year fee-adjusted end-to-end IRRs, they've rebounded somewhat here recently, although without liquidity, it's very difficult to judge a private equity versus the much more liquid S&P 500. On the right-hand side, you can see that that private equity funds of every vintage have matched or outperformed the S&P 500, and top quartile funds have outperformed the S&P 500 significantly. However, you need to note that the most recent figures on this page are based on unrealized valuation estimates rather than true returns, so you need to take this with a little bit of a grain of salt. So now that we've framed our discussion, let's start with a question for the whole group. Are managed alternative investments such as hedge funds and private equity worth the illiquidity and fees when compared to lower cost ETFs and indices? I think we'll start with everybody. We'll have them introduce themselves and their firms and then talk about how they view alternative investments. I think we'd like to start with Gordon. Gordon manages a large pension fund and I think might have a very interesting and unique perspective.
Unique, yeah, perhaps. So thank you, Andrew. It's the public sector pension for the Canadian government, and we're managing today about $95 billion, but it's a new fund, so the inflows are about $5 billion a year, and of that $95 billion today, we have about $26 billion invested in private assets, and another almost $4 billion in hedge funds, and about 75% of that is managed internally. Now, I'm going to say this right up front because of some of the comments I'll make, but there are some great managers, some great GPs that exist, and I think we've got both of them in our portfolio. But the challenge really is to find the great managers, because they will all tell you that they're great. They'll all tell you that they're first quartile, and the reality is that they're not. And the fee structure really does not distinguish. You have one fee structure which is pretty similar for all managers, and it doesn't distinguish between the good managers and the bad managers. So you need to really find who are the good managers. And the challenge is to make sure that the manager you're selecting is one which is aligned with you. That means that they're putting in real cash into the fund alongside your cash and not deferred fees. You also need to make sure that, I guess, that you're large enough that you can afford the kind of due diligence that it requires to get into the background of all of the managers and find the ones that have good alignment and good performance. You also need to make sure that these are very, very illiquid instruments, very illiquid investments, and you want to make sure that you have control of your capital. And that what that means is that no matter what the circumstances, you never want to have to sell one of these assets at a time other than your choosing. Because the reason we're buying these illiquid assets is because we're estimating we pick up about 50 basis points a year by owning something which is illiquid. That's the illiquidity premium. But if you're forced to sell this at a time other than your choosing, it's usually at the absolute worst time when there's a crisis or a liquidity crisis, as there was in 2008 and 2009. And a number of investors found that they had to sell these illiquid assets, and in some cases they were selling them at 50 cents on the dollar. So that 50 basis points a year disappears very, very quickly if you're not able to hold on to those assets through whatever comes your way. Now, if you can find a manager which is aligned with you, it's a beautiful thing. But if you end up with an asset-gathering fee junkie, it's you basically lose. Now, I guess if you're not able to do a lot of these things, then you're really better off putting your money into a leveraged public equity type of an investment, because this is expensive. Investing in these private assets is about 3.5 to 7 times as expensive if you're managing it externally versus whether you're doing it internally. So if you can't find a good manager, you are paying a really, really high fee structure. And what about in performance? Now, you've mentioned some performance here, but I think something that you want to do is really to try and compare like to like. And so if I was to use the Cambridge US all PE returns versus the S&P 500, but use the S&P 500 with a little bit of leverage in it, because when we're investing in these, particularly private equity, there is leverage in there. So let's use S&P 500 leveraged 50%. And what you'll find out, if you look over 3 years, the leveraged S&P portfolio has beaten the Cambridge index by 10%. Over 5 years, it's beaten it by 15%. And it's only when you look at it over the longer term, 10 years, then you finally get to see that this PE index is outperforming the leveraged S&P 500, but only by about 1%. So then you say, well, okay, well, we'll invest in these things, and we're long term, so we're going to hold them for the very long term. But Bain has put out their 2014 PE report, and they're saying that they're finding that last year, just in the US, there was $191 billion of new PE funds raised. That's an 89% increase over the previous year. And there's now about $1.1 trillion of unused or overhang, dry powder as they call it. So you've got all of this money that has yet to be invested hanging there. So if you go back and look at the 10-year or 20-year returns, you'd never had that sort of capital hanging and waiting to be invested in the market. But you say, well, you know what? These guys will give the money back if they don't find good investments. But a study at Emory University, the Emory Center for Alternative Investments, has found that GPs, once they have the capital, do not hand it back. You don't get the money back. They will find an investment for that capital so that they can get their fees. They'll even buy investments off of other GPs to make sure that they can put this capital to work. And now on top of all of that, a report from Bloomberg came out in the early part of this month saying that the SEC has investigated over 400 private equity firms and found that more than half of them are charging unjustified fees and expenses. So I think at PSP, we bought the dream and we ended up selling the nightmare. And so we have private equity, but a lot of it are direct investments. There are great GPs, and we have great relationships with some of them, but you have to be very, very selective.
Okay, Manning, why don't you talk a little bit about your firm and why you should be one of the ones that he selected?
Sure. So we've compounded since June of 2008 at 20%. We run about $6 billion. We have a very, very exact theme, and everything we do follows that theme. It's a very important theme that everyone in this room should realize it's going on, and it's very hard to accept. And that theme is very straightforward. One, because the U.S. financial system failed in October of 2008. in 2010, we had two gigantic pieces of legislation, Dodd-Frank and Basel III. Sachsen came within 20 days of failing in September 2011, would have brought the entire European system down and the United States system down, and maybe even the Canadian system down, would have brought the Canadian system down also, because everything is interrelated. And then we just had 5.5 years after the crisis, we had the Volcker Rule, which is as big as a telephone book, 2,000 pages, just 25 words in there, make banks sell $200 billion of securities. So what are we doing? We're just looking at two massive themes. One, every bank has to be made a fortress, and so that we don't take countries down because of banks, they go down because of wars, or they go down because of revolutions. So the two basic themes are every single bank is going to go from 0% capital, like Citicorp had in 2008, to 10, 12% capital. I mean tangible equity capital. The reason banks had such high returns is because they sold bonds, and those bonds were counted as equity. It was completely make-believe. The second thing the regulators have to do after they accomplish that, because you can't accomplish that, you have to first do that in the United States and Europe. They've already done it with the big banks in the United States, is you are going to turn every single big bank into utility, which means they are not going to do many, many businesses. And the way you turn them into utilities, you do it three ways. One, you make them run with 100% capital on anything you don't like what they're doing. Land loans, transitional commercial loans, anything you view as high risk, 100% capital. That takes them out of the business. Or the Volcker Rule certainly just simply bans them, or you harass them out of a business. So you see every single big bank in the United States, that's from Zions upwards, basically moving towards this area. So everything we do plays those two themes. So and how do we express those themes? Very, very exact. We're the biggest owner of TARP in the United States. We're the biggest owner of TRUPS in the United States. That means we can effectively recapitalize any of the 7,000 banks, little banks in the United States. The big banks in the United States are already recapitalized. The Volcker Rule makes it even more attractive because it busts CDOs up. It forces banks, big banks, which own about $5 billion of TRUPS on their balance sheet, makes them sell it because they hide them, they used to hide them as C&I loans, as commercial industrial loans. The second way we express it is we own about $3 billion of paper in Europe. This is all debt paper the banks must take out. They have no choice. And the reason they take them out is they can book gains and they can increase their net interest income because they replace them with deposits, with senior unsecured debt, or with new tier 1 type capital, or even COCOs if they can get away with it. So that's theme number 2. The other way we express it is through finance companies. Because in the United States, if a bank can't do the business, somebody must do the business. So when you see BDCs exploding, when you see direct lending exploding, that is a capital relief trade. That is only a good trade because of the regulatory reasons. The other way we express it also in Europe, which is really more extreme, is there are 0 finance companies in Europe. There's actually 3 finance companies. There'll have to be hundreds of finance companies. So we're very interested in doing finance companies in Europe, both through direct investments by creating them or by investing them. And we're active in the monoline insurance area because this is another regulatory, very, very important theme in terms of trying to make the monolines healthy. They go into, monolines don't go bankrupt, they go into Betty Ford Rehab Clinic, they go into a rehab, and therefore it goes on for years and years and years. So we basically, seems like we do a lot of different things. We're in CDOs, we're in TRUPS, we're in preferreds, we're in everything the banks ever issued or insurance companies ever issued. They're all going to disappear. They're all going to be taken out, and those are the regulations. And people need to understand this utility theme is unbelievably powerful and will change the landscape both the United States and Europe. You're already seeing it. You're seeing it from the Federal Reserve Board, and you're seeing it by, so far, an agency that's very, very powerful, that's tried to keep a low profile because the Consumer Protective Bureau basically has unlimited power, is funded directly by the Fed, gets to keep their fines, and consumers cover everything. So you're going to hear from them over and over and over again over the next 10 years. But this second theme of turning banks into utilities will take 10, 20 years to accomplish. It's like, it's a revolution. It's rolling the clock back to the 1940s. The capital part is rolling the clock back to the 1980s. So that's what we do.
Thanks, Manny. Michael, you run you run one of the most successful hedge funds in the world. What are you looking at for opportunities these days, and what themes are you looking at?
Yeah, well, the reality is that yes, we do run $13 billion, and we look specifically across the whole capital structure, equity and credit, even though we are very much focused on credit, to try to extract value. And the key, frankly, of why people would want to come to the alternative world, keys of what Manny has just been talking about, and that is the world has changed. The world has changed. If one wants to be able to get alpha, the reality is it no longer sits in the banks. The capital structure of the banks now is such that loans have gone out, ABS has gone out, a lot of proprietary trading has moved on, notwithstanding some of this still going on there. But the reality is it has created a huge opportunity for the alternative investment industry. And if I look at why in 2008 we were able to do pretty well, was because we had the operational infrastructure to deal with it. So that's the other thing. We are paid to take investment risk, obviously, that's and hopefully make the investment return. But at the same time, we make sure that we take that operational risk down to a dull raw. So the point is that we've got a situation where in our industry, the operational costs are very high, and the reality is we need to go forward. So how do we do it? Well, what essentially we do, we work across the capital structure, as I said beforehand. We also specifically work taking unstructured data, putting that into information, getting that to knowledge. And the reality is what we also do, we take that knowledge and we go to insight. Knowledge, you can write a term paper, you can maybe even write a PhD thesis, but you can't make any money out of knowledge. How do you go from knowledge to insight, which is actually the alpha stream? How do you go from knowledge to insight? And that is by context, by thinking up and down the whole capital structure. And the reality is that from there, we also then go and make sure we think about the timing. And one of the things we have in our firm is the ability to express a view on a company, whether it's in an equity, whether it's in a credit, whether it's in other structures around that, whether it's derivatives, credit derivatives, equity derivatives, and you need to think about the timing, and then you need to risk manage the living daylights out of that whole process to get the returns having an effective volatility so that it makes sense, and then get a good risk-adjusted return. And the point is, it's that context, taking knowledge to insight, which actually is where we work pretty hard at. The world has changed, and I think it's a very exciting world, frankly, for us to extract value.
Great, thanks, Michael. Leon, you've had a lot of roles on Wall Street over the years. How do you think about alternatives given your background?
Thanks, Andy. And I think you worked on your first transaction on Wall Street.
I did. You sold the bonds. I was very grateful.
We go back a long way. A couple of things that were said that I just want to react to. Manny said that banks are turning into utilities. I couldn't agree more. The way I think about it is, the characteristics that were, allowed myself and Manny and others to succeed at banks, and Michael would probably get us fired today. So, in terms of the alternative markets, first of all, the big are getting bigger. Clearly, institutional investors are, taking confidence in firms that they have had successful relationships with in certain product areas, have confidence in those firms that they can staff and extend those product lines, and you see the incredible asset growth
in this handful of firms. You know, I guess Apollo's 160 billion and Ares is 74 billion and Oaktree, et cetera. And I think that's all very good. I do think that there is pressure on fees now. As Gordon was saying, I don't think only the few managers can charge full fees for what has to be excellent performance, but the incidence of separate accounts is now definitely grinding down fees, including hurdle rates and things like that. So that's not to be surprised. That's not surprising, particularly in a market that has run so much, which is now becoming much more of an alpha market and less of a beta market. As a general comment, to your point, having been around as long as I have, and the way I'm thinking about the world is that in many of these instances, alternative managers are going to be charged, and their success is going to be based on unique sourcing, differentiated sourcing. What are you doing that's different than everyone else? And my observation about the market is, it reminds me very much of the kind of market environment, and we're talking about broadly the banking system and the alternative markets that existed before the high yield market existed. That is, there were a handful of banks. If you were an entrepreneur or were not straight down the middle of the fairway, you didn't have access to the banks. And then Mike and Drexel and everyone else came in, created the high yield universe. All these industries were created. Jobs, growth, creation, and then the '08 credit crash. Today you have a handful of banks. The high yield market is part of the banking system. If you're not straight down the middle of the fairway, you can't get access. It's very strange. So you need to be in the alternative spaces to get access to a differentiated deal flow, but it's out there. At the firm that I've created with partners, is our family office. We are partners with a small number of institutions we're close to, high net worth individuals, and we're looking for differentiated opportunities, which we're seeing. Pre-IPO biotech, very successful. Significant biotech transaction with kind of a troubled history. There was a lot of value added that was able to be created and a lot of excess return. The hotel that we're sitting in today, the Beverly Hilton, after '08, it was, I know people don't know this, but the Beverly Hilton here sits on 9+ acres of property. And the owner, Benny Allegem, knew that he had the rights to get entitlements to put another Waldorf Astoria, another hotel, Waldorf Astoria, with improved conference facilities and condominiums here. But because of the difficulties in the financial markets, was not able to do that. Now people are waking up, and in 2 years, this conference is going to be in the new Waldorf Hilton conference facilities, and the people who invest are going to be doing quite well. So there's a lot to do, and I think it's about differentiated sourcing.
All right. Thanks, Leon. Neelan, as the private equity representative, why don't you tell us a little bit about your firm and what you're seeing in alternatives today?
Yeah, thanks very much. And I, concur certainly with my colleagues on the panel in terms of their observations with regard to private equity. Pharos, again, we principally focus in middle market, lower middle market, buyout, growth and expansion capital. And it's a much less efficient market where we, quite frankly, feel we can be differentiated on many different levels as compared to some of the larger buyout firms. First and foremost, our focus is on healthcare. And again, in light of the Healthcare Reform Act, you'll see, tremendous displacement, and therefore we think, extraordinary opportunity. Of course, we've been investing in this space for about 15 years. Prior to that, I practiced medicine for about 10 years. So we have, we think, a keen insight both from the clinical side as well as the public policy side. And we think that within the opportunities in the private equity space, that healthcare is one that will provide outsized returns relative to the risk. Again, you want to Gordon's point, invest in very good managers where there's an alignment of interest, where they have conviction in terms of their GP contribution, but also, again, we think that middle market managers, quite frankly, are highly motivated, maybe a little bit more so than some of the larger firms in terms of making sure that they generate very good risk-adjusted returns, because, again, they don't have the ability to make mistakes as compared to the larger firms. And so within the healthcare space, we think there are several opportunities. And again, we focus primarily on healthcare services. So we think data analytics, which has been an important part of some of the other verticals in business, we think data analytics will be an important part in the healthcare space that heretofore has not been focused on. We like, quite frankly, the behavioral health space, where there's been a disparity in terms of access to capital in this space, particularly in more underserved communities, which is where we generally focus. And again, so our first investment in our current fund is in the behavioral health, mental health space. Again, with the Affordable Care Act, you have much greater coverage for the population, and therefore we think there's going to be tremendous demand as a consequence of that. Things that, of course, improve quality of care, create greater efficiency and lower cost are certainly themes that, regardless of what happens with regard to the Affordable Care Act, those are things that I think the healthcare industry are embracing. And again, there's an interesting company that we've been advising from one of our LPs that actually cuts and cauterizes at the same time, such that again, if you take a hip replacement, in this particular case, the orthopedic surgeon does about that we've been discussing with does about 30 a month. In 28 of those cases, he has to have a blood transfusion. Last month I checked with him, he had 1 blood transfusion. So again, that's going to dramatically improve the patient's ability to have a better outcome because they are not exposed to blood transfusion, but also because of the lack of swelling, they're going to be discharged sooner, and again, that's going to lower cost, and outcomes inevitably should also improve. So again, we think interesting, compelling opportunities that impact the healthcare marketplace like that, or things that we should continue to evaluate. And again, I think that certainly in the middle market, given the lack of transparency, less efficiency, there's the ability also not only to provide capital, but also value add beyond dollars, which is an important component of what we do. Again, not only serving on the boards of directors of these companies, but actively engaged in helping them to be successful in terms of executing on their business strategy. So we're very much active investors, and as a consequence, we see much more receptivity from the entrepreneurial community to embrace folks like ourselves to be participants, not just as private equity investors, but as true partners in the evolution of their respective firms.
Great, thanks, Leon. Leon, you wanted to add something?
I just wanted to add one thing. I talked about the LWP dealer side. We do have a business that helps asset managers start. And to Gordon's point of, kind of back to the beginning of the hedge fund world, when you were looking for smart investors who were, taking your money and managing next to theirs, which was, I think, kind of the model for the first, 15, 20 years of the hedge fund world before it really institutionalized, and along with that was maybe black box, not a lot of transparency. And since then, there's a tremendous institutionalization of, tens of millions under management, with perhaps less of an alignment to what Gordon was saying. Today in the market, we think there's an opportunity to realign that, and there's much as there is in the capital markets of this dislocation and people looking to be hooked up. In the asset management side, the same thing. You have a handful of seeders, you have just a handful of people who will, kind of cut large capital, but there's a lot of talented people out there who have ability, And we're looking to partner with them, and we're finding a lot of opportunities.
Okay, great. Thanks, Leon. The second topic we wanted to go through is actually up on the slide. Given where we are in the cycle, where do you see opportunities for outsized returns, and what's your outlook on alternative investments? There's actually a slight typo in there. It should say, where do you see opportunities for outsized returns other than buying Leucadia stock? But other than that, this is why. So Gordon, why don't we start with you? Where are you looking right now, again, other than Leucadia stock, to get outsized returns in today's world?
Well, let me say that in terms of what my colleagues up here are discussing, I have no issues with the sorts of assets that they're looking at, and there's some great opportunities.
So when are you giving us money?
Yeah, exactly.
I'm going to go out of the back door when I'm done here. I got to say, I noticed that Neelan's wearing a pair of cowboy boots, and it's making me very nervous.
I'm from Texas.
Yeah. No, but I'm expecting to feel it later.
Yep.
It's not with the underlying assets. It ends up how you get there. And so the issues that I mentioned were really about, well, first of all, the illiquidity. You need to make sure that you can stay in any of these assets. But it's the fee structure and the lack of alignment. So in terms of the sorts of opportunities that the fellows up here are seeing, I think that's great, and they have that opportunity. And we're interested in finding people like that. You just need to make sure that you're aligned with them all the way through. But in terms of opportunities, we're still seeing opportunities from both regulatory and balance sheet pressure. And if you can move quickly and you can understand the underlying investments, there are still opportunities there. Emerging markets, energy investments, we've made a couple of interesting, very strange, but interesting investments there in India and in Turkey recently in the last few months. And I think as well, we've got to pay attention to the credit cycle. It's maybe not, we're not ready for that yet, but I think there'll be more distress coming, and you've got to be prepared for that. And so, all of the things that were being discussed up here are opportunities. It's just how do we access it is really the issue I'm trying to get at.
So do you think that pension funds are leaning more towards managing internally? I know you guys are doing that. Do you think that that's a trend in the pension universe?
Oh yeah, for sure. And there's a group called CEM Benchmarking that surveys all of the big funds like ours, sovereign wealth funds, pension funds from around the world. And if you look at it, you can see absolutely that there is an increase in the allocation to these illiquid and these alternative asset classes. What's interesting, though, is I'm here making the case for finding a good manager on the outside, and if you can't, try and do it on internally, because it's a lot cheaper. It's about I think it's about 28 basis points is what it would cost to manage private equity internally at a fund like ours or one of the other big funds. It's about 165 basis points if you give it to an external manager, and if you don't want to do any selection at all and you want to have a fund of funds, now you're going to be paying 255 basis points on average a year. So the funds like ours, they're making increased allocations around the world, but what's interesting is obviously they're not here today listening to me because there's actually an increase in allocations to the external managers versus doing it internally. And you have to ask yourself, well, why is that happening? And I think that if you go around the world and look at a lot of jurisdictions, the pools of capital like ours are really being managed as a department of the government, for example, and there's all sorts of governance issues. They have restrictions on their compensation, which hinders them in trying to build teams of experienced people. And there's also political interference in the investment process. And all of this leads to leakage. And leakage from taxpayers, leakage from pensioners to, I guess, the next unaligned GP who's turning 60 and wants to hire an aging rock star to sing at his birthday party. So there's definitely a shift to these sorts of assets, but it's still to external managers. And I think, in Canada that's not the case, but in a lot of places still, you're seeing it going to external managers.
So Manny, what opportunities do you see that you can point out to Gordon to justify the fees that you're charging?
There's three gigantic opportunities that I see. One is there's 7,000 community banks in the United States. I've been involved in them since 1985. You're watching a revolution taking place right now because they finally have a gun to their head and the regulators are encouraging them. One, you have TARP. The Treasury is selling. They made $60 billion. They're looking to declare victory. They've got $5 billion to sell. It's not easy to buy it. You have to be approved by the Federal Reserve Board. They're selling them anywhere from 30 to 60, 70, 80 cents on the dollar. It's like me owning your mortgage at 50 cents on the dollar. There's TRUPS. There are 5 billion of TRUPS in the banking system owned by big banks, another 10 billion that can be broken out of CDOs, that's 15 billion. Now you own TARP, you own TRUPS. You basically can sit down with a bank at a table, a small bank, and cut the deal and make them healthy overnight. And that has a triple impact because they have hundreds and millions of dollars, billions of dollars of deposits sitting in treasuries. They finally can loan it out because they're out from under the Federal Reserve Board. So that's one interesting area. You can play it through the debt and the equity, and it's an area where there's very, very little competition. The second area is Europe. You have to understand European banks, Western European banks, are $38 trillion. The GDP of Europe, of Western Europe, is 17 trillion. So the banks are bigger, are twice the size, more than twice the size of the GDP. In some countries, they're 4 times the size. European banks are different from U.S. banks. They used to do everything. They finance themselves not with deposits, with bonds. There's $800 billion of these bonds out there still, and in many ways, they count as equity. It's mind-boggling, as if your mortgage counted as equity. So all those have to be taken out. That is, in Europe, is in a slow recovery, but to get that recovery, first you have to fix the banks, then you have to create a normal lending situation. So that's a very, very powerful area that's going to go on for 4 or 5, 6 years. It is in the recovery. We have a new sheriff in town. You always need a powerful sheriff, and that is the ECB. So starting in October, the ECB will be doing the mainland banks because you can't have Spanish banks regulated by Spanish regulators. It's a joke. Italian banks regulated by Italian regulators. It's a joke. So you've got to no one wants to take the hard medicine. You now have regulators making them take the hard medicine, whether it's raising equity, buying back their debt, issuing different types of securities. The third area is a gigantic area because it's trillions of dollars, and that's in the United States. Finance companies, and that's really why Ares has been so successful, or Gullo Capital, or other people who make direct lending. But there's niche after niche where a bank is being forced out. Once you get the gorilla out of the way, it's now a question of finding the right operator and making sure they can securitize. Because if you can do that, then it has a double impact. Not only do they grow, they have cheap capital. You do that both in the public markets with the smaller companies, and you also do it in the hybrid market. When I say hybrid market, you fund companies that do this, who already have 500 people on the ground, who for whatever reason are not a principal. You build them out relatively quickly, and you go to the public markets. Because in the long run, the public markets will always be the cheapest. In the long run, they will disintermediate even hedge funds in different areas. Europe is not going to be a viable economy if they have to pay 13, 14, 15% for loans. It's impossible. So over time, these are the 3 gigantic areas, and they're huge that we think are the most interesting.
Michael, you have a good global perspective. What do you see out there in the world today?
Yeah, well, again, the value obviously comes from where there's dislocation, and the massive dislocation that's happened out of the central banks, whether it's through QE or through now forward guidance, or gone to qualitative guidance, where these guys have pushed, frankly, all the assets into one situation. For us, gives an opportunity, but also there's a heck of a risk, in my view, in that the possibility of having a Minsky effect is that sooner or later the chickens will come home to roost, and we'll get back to a normal market. You've got, talking about European banks, the credit spreads are right on top of each other, whether it's a highly levered, aggressive French bank versus a bank, a UK bank that's in ownership of the government. They're right on top of each other. There's the ability to do those trades in credit, using credit derivatives. There's also the ability to to play equity long short. Now, the reality is equity long short in the US became very crowded. It's not so crowded in Europe for one reason or other, and it's definitely not crowded in Latin America. So again, you need to think about where that is. But talking about a secular issue is that the loans, the European loans, have become very attractive. In fact, they're trading, they're senior in the capital structure, but they're trading right on top of sometimes even wider than bonds, because CRD4, again, the regulator in their wisdom have made it well nigh impossible to do CLOs in Europe, and you definitely can't put the CLO these bonds, these loans, I should say, into UCITS product. So again, that is very cheap indeed. So I mean that's just two places where there's, in my view, opportunity from government dislocation.
Thanks. Leon, Manny talked a little bit about BDCs. How do you view BDCs as an alternative investment given their greater liquidity?
I think they're a viable alternative. I think, like everything else, it's who's the manager, have they done? It's not, the performance is not as close to each other as you would think. One of my own personal surprises that I'm trying to actually get an answer to is, I guess, Manny was just talking about, BDCs as an originator of loans, which I think they were supposed to do and create, capital availability for growing businesses. I do think that generally, if you look at them, they participate in the syndicated market more than I think the original, creators of them would have thought. Having said that, BDCs, Ares has paid a 10% dividend since inception 10 years ago. I think it's terrific.
I was just suggesting that BDCs have grown because they're doing loans that banks normally would do. We don't do any BDCs because it's too crowded of a space. There are some great BDC companies, but there's 5 BDCs being created every week. So we're not interested in anything that doesn't have barriers to entry.
Right.
But there are great BDCs, but it's a very, very, very crowded space because there are no barriers to entry.
Right.
3 people in a room can create a BDC just the way 3 people in a room could create a $40 billion mortgage REIT.
Right. But to answer your question, I think one of the things we haven't touched on, but it's an interesting topic, is that the alternative business now is completely, covering a tremendous spectrum from the most sophisticated institutions of, the California pensions and the CPP and Gordon, et cetera, to where a lot of these structures make sense for them because they have so many billions and hundreds of billions to deploy, to the retail investor. And now you see the retailization, if you will. And I would say that BDCs are probably better, for the retail investor, and it's probably heading in that direction.
Neelan, where are the opportunities in private equity right now?
I think that there are several fold, but I wanted to also kind of speak to Gordon's point. I think that the reason why the fees in private equity are high, despite the liquidity, is performance. That is, the top quartile funds, if you look back at the chart, have really outperformed the S&P by a significant amount over the past several years. And if you look at the horizon for pension funds, it's a long horizon, and most of them, with the traditional instruments they have not been able to meet their actuarial targets. And so this is a vehicle, an asset class that provides the ability to kind of meet their actuarial targets and beyond. And quite frankly, I think that the fees are worth every bit of it and more. And if people, perform, they should be compensated. And if they want to have an aging rock star at a party, they should do that if they can afford it. So I don't apologize Not that I've ever had one in my house, but you know, I think that, you know, the glory, at least of America, I don't know about Canada, is capitalism. And, you know, yes, there need to be regulations, and yes, you want to make sure that you back the right managers and there's an alignment of interest, and that there is, you know, that you, again, you are investing with the right people at the right time. But, you know, there's tremendous opportunity. And so what I would say in terms of other things, I mentioned principally healthcare, but what I would also say is healthcare is not local, it's global. And so for us, we see the opportunities to expand from the lessons here in the US in the global marketplace, you know, particularly in the Middle East, but also in the emerging markets, where there isn't the sophistication maybe in terms of delivery, there isn't the sophistication in terms of medical devices, products, et cetera, because if you look at, unfortunately, one of the things that America has done is export bad health a lot of places with fast foods and what have you. So you have this massive epidemic in the Middle East in terms of diabetes, but also, you know, even in the continent of Africa, you know, a real problem, certainly in Nigeria, with regard to renal failure. And so, look, we are looking at staying focused in what we know, which is healthcare, and doing that very well, but also the ability to leverage that expertise globally and continue to create very good, you know, risk-adjusted outsized returns.
Andy, if I could just add, so Neelan's in the middle market. I guess you said your last fund was 500 million. Mm-hmm. As alternative managers get larger, it becomes much more difficult for them to, I think, you know, find idiosyncratic investments that are going to produce returns when your assets are 25, 50, 100 billion, and 1% positions. You know, to impact the portfolio, you have to invest, you know, 150 to 200 million dollars. I mean, right. I think you have to find liquid markets, maybe like what Manny is talking about, but absent that, I think you have to find, you know, managers and areas that can take smaller amounts of money, which is kind of back to the beginnings.
Right. But so Gordon, you know, as was mentioned earlier, it seems like all the funds are flowing to the largest alternative managers. How do pension funds think about picking the managers? Because as Neelan points out, picking the manager is the hardest. It seems everybody's following the herd to the largest managers, but as Leon points out, you know, maybe the middle market managers is really where all the alpha is to be created.
Well, it's not a very transparent industry, and I imagine the old, you never get fired for, what was it, IBM or Xerox or something? Right. I imagine there's a lot to do with that, because it isn't very transparent. And as I said in my opening comments, it's very expensive and time-consuming to do the sort of due diligence you really do need to do to try and shine a light onto some of, well, you know, what's the alignment, who are the partners, with the other clients, follow up on partners that have left the firm, with clients who've left, and look at all of the investments going back as far as you can. It's a very, very extensive and expensive process. And honestly, Neelan, I'm sitting on the other side of the table. If I was on your side of the table, it's a great gig if you can get it. If you can get 2 and 20, but this fee structure was not put in place originally for people who were going to be managing $30 or $60 billion. And I think, Leon, you made that point, and the industry's changed, but the fee structure really hasn't. I don't know, did I just answer your question, or did I go off topic back to what my...
Gordon, I think the fee structure has changed. I think fees are coming down. I mean,
they are.
You see, and you see now larger funds like Apollo and others are not getting paid until capital is deployed,
you're right.
Let's say, as opposed to...
Again, and also, again, European waterfall, you know, look, as opposed to a deal-by-deal structure, I think, of course, ultimately it's the responsibility of the limited partner who's making the investment to kind of determine the economics. I mean, there's no law that says it's 2 and 20. I mean, at the end of the day, you know, what's fair is what you negotiate. And so, you know, it's imperative, and I think the institutional investment community has done a much better job of late with the 08, 09 crisis to kind of say, whoa, time out. Wait,
Yeah, sure.
whoa. And so, again, having served on the board of Texas Teachers, which is $128 billion pension fund, I've kind of been on both sides of this trade. So I recognize very much as an LP the types of things one should be aware of. But again, it's my responsibility as an LP to kind of negotiate the best terms and conditions for my retirees. Just like as a GP, you're going to try to negotiate the best things you can for you and your colleagues to attract the best and brightest people and that kind of thing. And so,
But there was, for sure, after the crisis, it was very difficult for a lot of the big funds and the small funds as well to raise capital. So you're right, they've become much more sensitive to that. But if you look at the jurisdictions such as Canada, where the governance is different and more of the money is being managed internally, or they're large and they have negotiating power on fees, on alignment, there is a model that's developing there which is different than elsewhere. And I know that some GPs point at the model in Canada and say, well, it's unsustainable, it's going to fail, they can't do what we do. And the reality is that there's a lot of funds, and we've been having meetings here, there's a lot of new funds that are starting up around the world, in the Middle East, in some of Eastern Europe. And these are large and very rapidly growing pools of capital. And they're trying to figure out how should we manage this pool of capital. And the amount of visits and calls that our fund and my colleagues in Canada are getting, and then they'll come and visit, they will second people for extended periods of time, and actually they're stealing some of our people. They hire them and they take them back to the Middle East or to Asia, wherever, and pay them well, tax-free, to learn exactly what it is. Why is that Canadian model working, huh? So why is it working? And so what ends up happening is this model isn't going away, and the GPs, as you were suggesting, Leon, that are learning how to work with that model, they're going to survive and they're going to prosper. But those who are resisting it and saying, well, you guys are the enemy because you're our competitor, they're going to have an increasingly difficult time to raise capital in the future, because this model isn't going away. From what I see from these large growing pools of capital, it's only going to expand over the next 10, 15 years.
I think everybody agrees with Gordon.
When you say this model, just explain what you mean by this model in Canada.
The model where we're doing a lot more investing directly, we will start new funds, so we'll take people out of existing funds who are really tired of working for asset gatherers and are in love with investment, and they want to go off on their own, and we will fund them. And what that does is it allows you to make sure that there's great alignment, you have preferred economics, you will do large co-investments with them outside the fund structure where there are no fees, no carry, and so it's more of a partnership, and you're willing to we'll put in $500 million into a fund, but we'll have a $500 million pool on the side for co-investments with them.
By the way, I agree. I don't think the Canadian model is going anywhere, nor should it. I mean, I think that competition is very good. I don't necessarily, though, see it evolving in a significant way, at least in the United States, principally because of the fee structure with regard to governments and the fact that in terms of attracting often the best and brightest people to manage these assets at a city, at a county, or even at a state pension fund, you're not going to be able to pay people what
but
the
Leland,
private
you
sector.
are paying it. You are paying it. It's just that you're paying it to the GP.
Understood. No, understood.
And that's
But
where the
I'm-
leakage is coming from.
Yeah, but all I'm saying is to pay a chief investment officer or $500,000 at a state pension fund in the United States, that's just generally not going to happen. I mean,
Well,
I think Neelan's right, Gordon, in that we've seen instances where political considerations come into play when a successful CIO at a particular county or whatever, they go, you're making what after having produced great returns, and then are forced to leave. What I was going to say to you, just for what it's worth, when somebody says, you can't do that because you're not talented, my response is, there's no monopoly on brains. Just so you know, you can use that anytime.
I mean, we all know that the fee structure is going to be adjusted if performance is not there, is going away, period. And we know that the power has moved towards the gigantic accounts, the ERISA accounts, the sovereign fund accounts, period. And to the extent that someone's going to write a check for $500 million or $1 billion, the fee structure is going to be adjusted, period. End of story. And maybe it's not going to be adjusted if you're $30 billion, but it's going to be adjusted if you're $6 billion.
So Manny, we've talked a lot about fees. The other criteria people look at is liquidity. Why should people be putting money
So liquidity,
into private equity versus hedge
we
funds?
try to solve liquidity three ways. We have liquid funds where only liquid things go in. In fact, all our borrowings, our liquid funds are Reg T borrowings, period. So we could liquidate very, very quickly. We don't even use repo. The Fed, anyway, is attacking repo. That's another thing they're attacking. They're coming at every single fund the same way they're coming at banks. So we solve it by having liquid funds where we give people 90-day liquidity or 30-day liquidity. If something is illiquid, it goes into a separate bucket where they can choose to be in it or not be in it. Then we have hybrid equity, which is illiquid. So hopefully, theoretically, they're going to get a higher return. We just simply divide it into buckets. If it's a TARP piece and it's liquid, it goes into one fund. If it's a TARP piece, if it's illiquid, it goes into a fund that is not liquid, is like a liquidating trust, period. That's the only way we can solve it.
Michael,
But most of the stuff we're dealing with, a lot of stuff we're dealing with is really, Reg T type pieces, and that includes European bonds.
Michael, how do your funds work liquidity-wise, and how do you think about that, and how do your investors think about that?
Well, again, I mean, you need to match your assets to your liabilities. I mean, the biggest issue that happened in 08-09 was that the assets and liabilities weren't matched properly, and I mean that's the key. I mean, what Manny's talking about is exactly the sort of process we have. The funds which I manage, it's a monthly. You can call your money monthly, but it comes out 6 months now, and that's the sort of assets which I've got there. There's other things which we've got in the 40 Act space, which again, I mean, you can get out of it overnight. And again, it goes back to having the operational infrastructure and the discipline and the process to be able to deal with those points. And I think that's one thing I think the industry has learnt pretty much. Don't mismatch your liquidity versus your assets.
I think one other thing you wanted to talk about was you saw some opportunities that the central banks around the world are creating. What are those opportunities that you see, and how are you taking advantage of that?
Yeah, well, I mean, look, I think we've talked about it a little bit already. It goes back to the fact that the banks have been pushed around, and again, it means that we've got banks which are frankly much less profitable, and it's meant that we can actually do the work without the banks getting in the way. But let me tell you what I'm really worried about, which is in fact, I'm seeing the Times rolling down, is the geopolitical risk here. And frankly, the geopolitical risk that we've got comes in my view in three buckets, the longest tails. Firstly, we've got China having a potential geopolitical accident either with Japan or in the South China Sea, specifically with America in the middle of that. That region of the world has got about 60% of the world's trade goes through those oceans. 40% goes past Singapore's door, which is why Singapore's so wealthy. It's not bad having that sort of traffic in front of you. But the point is that there's a geopolitical bucket. The other problem that I can see is the Chinese shadow banking system. Again, China's self-contained. The reality is that their shadow banking system is sucking funds in from the outside, from the banks, through the carry trade, which occurs through either over-invoicing or through these guys are saying they're buying commodities, and the reality is that money then goes into the trust. If the trusts fail, that goes straight back out through the system into the banking system, the global banking system, and we sort of have a good sense of who those banks are. And the third one again is the game which is being played with Ukraine. Sanctions, fine. If the sanctions stop people from getting, stop some of these guys taking their kids to Disneyland, that's one thing. If these sanctions, what they do mean that the trade finance, which there's about $70 billion of trade finance out there at the moment. If that goes non-performing, if Gazprom loans go non-performing, Lukoil loans go non-performing, that will absolutely smash some of the European banks around. And I guess Manny will be able to keep, and ourselves will be able to buy a lot of stuff from them. But man, oh man, that could be a real danger. So as people are talking about sanctions, they better understand they're not talking about trade. They're talking about, again, doing a financial damage to the world.
Well, thank you for that. Thank you for that insight, and thank you all for joining us here today.
Thank you.
Thank you.